Howdy, Jacob here. Today we're looking at BJ's Wholesale Club. Been seeing those commercials recently. I want to say on Hulu or something. It's like, oh my gosh, did you see? We're getting a BJ's Wholesale Club. Anyways, all right. So growth on the revenue side is pretty impressive. Um, I did just want to say I think BJ's is similar to a Costco. Obviously less popular, but they really get that revenue in stream from membership, and then from there get to sell discounted items due to selling things in bulk. And I mean, it's been pretty popular from what I've seen. 12 billion market cap, pretty much the same enterprise value. Founded in 1984. I mean, obviously Costco's done a better job, but I really think that this is still a very solid company, and you can see from the return on invested capital, you're still looking at low 12, 13%, with gross margin 18%, operating margin 4%. That's pretty solid for companies that sell goods for sure. So not bad figures there. Balance sheet shows 36 million cash on hand with 319 short-term debt, 398 long-term debt. I mean, I'm sure in relation to earnings, that's going to be pretty much nothing, but I'm always skeptical of companies that have no cash on hand. It's the same as a person, right? I mean, if you lose your job, it's best to have a little bit of safety. Everyone's different. I mean, I understand if you're in a job that, if worse came to worse, you could probably get something quickly, but it's just safe to have some cash on hand. And then also opportunity wise, it's not just for safety, it's also for opportunity. Think about the fact that um, what if an acquisition possibility came up and you just didn't have the cash for it? And then by the time you went to a debt issuer to try to get your debt, somebody else got them, picked them up. That it's nice to have cash on hand for multiple different reasons. And so for that, just to have 36 million, I'm a little skeptical of. But again, that debt figure of 700 million short term and long term is less than 2 years of their 5 year average free cash flow. So I'm really not concerned about that. But use of cash really just okay, dwindling down that debt and share repurchases, one acquisition here. Um, all right, that's fine. I mean, again, they're just going to get to a point where the debt is gone, and then I want to see them very strategically be making acquisitions, reinvesting at the rate that you get 12, 13% historically. That'd be a fantastic rate of return. And then buying back shares that are advantageous for you, meaning that they're cheap and give you a good return on your investment. So I think I'm ready to start making some assumptions here. I think on the revenue growth side, I probably could see if I think inflation is going to be 2, 3%, they'll probably beat that by 2, 3%. Maybe let's do 5. I do think that, with the margins, it's still tough, but I'd like the business model. So maybe let's do 17. That's a tiny bit premium over the market. And then they're fairly consistent here. Not as consistent as a Costco, but fairly consistent. So maybe let's do 2.5, 2.7%. With share change, 1% would be about 120 million. House said that about 170. And I think that that's honestly pretty reasonable, leaving about 50% to acquisitions, reinvestment, debt reduction. And yeah, that gets us to a price needs to fall 59% before you get the return look for here, though. So I will just be waiting. But I do think it's a great company, not as good as Costco. I personally have a Costco membership, not a BJ's, but I see the gas prices. They're pretty comparable. Been inside, it's all very comparable things, and their models really the same or very similar. So, yeah, I do hope you enjoy the video. Have a great day.